Good morning, ladies and gentlemen. This is Clueless A Trading Frank on an absolutely beautiful early fall weekend here, Sunday, September 25th, 2016, 11:08 or 11:06 a.m. Eastern Standard Time. Full disclosure, this is purely for financial education and not for any solicitation or advice. Session will be recorded and uploaded to the YouTube channel and will be available to paid ACS members. And the way it's done, as you know, is the back office goes ahead and adds your email directly on the YouTube video, and you get a notification when it's fully uploaded, so you can review it at your given time. Okay. Let's make this next hour and change, as it always, becomes. I don't want to make it 2 hours, but hour and change to keep everyone's attention constructive. And I'm going to take a quick roll call here. We have Lizzie, we have Corey, we have Izzy from distant lands. Welcome, Izzy. We have Jules. Hi, Jules. And make sure that all my systems are moving fast. We have good old Carrie. We have Seashell. We have Tim. And we have Will. So that's a good crowd, and that's important going into next week and going into October. So I want to make sure that everyone can hear my voice and also see the screen in the back. We're going to focus today on one of the most dynamic and strategic chart platforms, which is the quad, what I call Algo HFT charting platform, and you see that in the back. Just want to make sure that everyone has visual, audio and visual, please.
Yes.
Excellent.
Yes.
Okay, great. Great. It's kind of a moot point because somebody doesn't have audio or visual and are signed on, they can hear me. I'm just kidding. So, all right, let's see here. Good. So let's kick off. So a couple of points that I always make at the beginning of these coaching sessions is regarding the sentiment in the market. Reading market sentiment is extremely difficult business. It really is, believe me. It's very easy for me to say, very easy for others to say, hey, the markets, majority are bullish, majority are bearish, and all that stuff. And there are numbers out there, Intelligence Investor Survey, they have the AAIA numbers, American Association of Individual Investors. You have a whole bunch of blogger numbers which are available for free on tickersense.com. That's run by Laszlo Barini, which measures the sentiment of newsletters, bloggers, and stuff like that. And there are other sentiment measures which are measured on a very technical basis via the put-call ratio. And one that many don't know about is called the call-put ratio. And that call-put ratio is provided by the ISEE, which is the Chicago International Stock Exchange thing, run by the CBOE, Chicago Board of Options Exchange. So if you go to cboe.com, I'll actually take the hard work away. I'll post a link so that you guys can click it. You can put your email there. At the end of the day, somewhere between 4:15, 4:30, you get the ISE numbers. It's very interesting because it's just the opposite of a put-call ratio. It's a call-put ratio. So logically speaking, the lower the number, obviously, that's means there are less calls being bought versus puts. And so if the number is, let's say, 0.56, then it's 56, roughly hypothetically speaking, that's a ratio of 56 calls being bought for 100 puts out there. Okay, so it's a tricky read. I've been tracking it for a few years now, quite a few years now, and what I do find that when they go into extremes, when they go into extremes. For example, if the call put ratio, and remember, call put ratio, right? Not put call. So the call put ratio runs up to, let's say, 140, 150. Large number of calls are being bought versus puts. Now, these are institutional, primarily institutional numbers, okay? And so what happens is they take into account, retail numbers too, as to us buying calls and puts, puts and calls and stuff like that. But when you get into extremes where it's like, let's say 0.4, which means there are only 4 calls being bought for 100 puts out there, versus a very extreme number on the other side, let's say 150 or 160, that means 160 calls being bought for 100 puts that are out there, then you have you start to look at it whether or not, and you match that with what's happening in the market, and you kind of get an idea whether or not the market's overbought, oversold. So that's another sentiment indicator that we look at, and there's a whole bunch of services out there which specialize in looking at trying to figure out the measure of what investor sentiment is. Here's the problem. The problem is that markets are the number of participants in the market, on the from the individual side has largely diminished. Active traders like us, yes, we're there. But at the same time, when you look at the real masses who were investing in the markets back, believe it or not, the highest participation in the market, in the stock market, and most people don't know this, was during the dot-com bubble back in 2000. Even during the move in the market from 2000 all the way up to about 2007, before we had the big correction, big crash that culminated in the lows in March 9th of 2009, you did not have large participation by individual investors. I know that for a fact because I ran money. So I know. I was on Wall Street. So, the excitement wasn't there. It's starting to build up, and then came. The reason the excitement wasn't there during that particular market peak was because everybody is gambling in real estate. Either you gamble in the stock market, which in my opinion is more of a calculated gamble, or you gamble in real estate, or you just gamble. You go to Vegas, you go to Macau, you go to Atlantic City, you go to wherever, go into the reservations, Mohegan Sun, and blow your money, which I think is the real gamble. Because in that case, the house always wins. So the point is that the overall majority sentiment in the market is pretty damn low. And I monitor many different numbers and try to get an idea of what's going on, and just a general feel of the market, which is a gut feeling. So whether or not, the animal spirits are running the market. Here's the difference between before and now, aside from the lack of participation by the individual investor, who is totally, even with the markets making new highs, multiple times making new highs, still thinks that the markets are down. Believe it or not, that's the general sentiment out there. Go ask people. Okay? Is that the fundamental difference is the markets are run by machines. Period. Okay? There are large institutional money managers. There are large institutional mutual funds which are running money. There's a great deal of cash on the sidelines. Either they're sitting in money market accounts, and that's primarily because also mom and pop, if you're in a mutual fund, they call up the mutual fund company and said, listen, I don't like the way things are going, which is always the case, all right, up or down, and move my money into money market. I'll wait till the time is right. The famous last words, which is the biggest manufactured truth. Okay? It's the biggest manufactured lie, I should say, in the universe. There is no perfect time. There are close to perfect times when things are that ugly that you don't even want to turn your screens on. But aside from that, so being machines having driven markets, you have to understand this because this is critical for all traders and investors. Critical to the success. One of the most critical components. Because the machines are running markets on a numerical, mathematical basis, markets can get overbought and oversold. I show that every single day on a shorter time frame. I show that also on a longer time frame, whether or not we're overbought or oversold. So when you get overbought, it doesn't mean there's euphoria in the markets. Yes, a little bit of the animal spirits come in. Mom and pop tries to get in there right at the highs. And guess what happens? Market drops 500 points, 600 points, 1,000 points. So what happens is the general mentality out there in the investment public is, man, I can never win. This is a rigged system. You hear that all the time. This is a rigged system. That's complete, excuse my French, bullshit. All systems are rigged. Life is rigged. That's the reason we fight every day to make a penny. So you hear this crap about, oh, the market's rigged and stuff. Well, when the market was down 1,500 points or 2,000 points in 2015, or we get a 1,000-point drop in the market in 48 hours, that's also rigged? Sure it is. So rigged systems can be down and up. And it really doesn't matter to us traders whether the system is rigged or not. Okay? Our job is to make money with the cards that we've been dealt with. Otherwise, walk away from the table. So because the machines and the algo HFT black box program, that's short for algorithmic high frequency trading black box programs, dominate the marketplace, it is fundamentally a very different marketplace than that many of, I would say the majority of traders out there can put their arms around. They're still stuck on the old-fashioned way of looking things. I know the old-fashioned way doesn't mean it doesn't work. Yes, it works, but it works a lot less than if you adapt yourself to the new normal that we're dealing with. And that's why I keep on harping on it and keep on pushing it down people's throats. Like, learn to adapt to the new reality. Because if you don't adapt to the new reality, and simply keep on looking at the same old stuff that everyone out there is looking at, you ain't going to get an edge. And the edges come off the most unexpected moments. And we have pinpointed many of them from the top and from the bottom. So what gives is that we have a messy, it's structured, by the way, like they say, through chaos. Order comes through chaos. Okay, the chaos theory. Google it. So what happens is that we as humans, we are looking for predictability. There's nothing wrong with that. That's in our genetic code. That's how God created us. We're looking for predictability, which by the time it comes, it's too late. And the reason why it's too late, not because in reality it's too late, is because the machines make us think it's too late. So we keep on, the average trader keeps on getting in late, getting hurt, and basically this repeats itself like a broken record, like my term like to use, which is same old story. It is the same old story. Every crisis, market drops, market falls, whatever, is the same for different reasons. And we're going to get a whole bunch of them as we get towards the end of the year. Whole bunch of them. So let's try to discipline ourselves. Technical analysis in itself is not just a bunch of lines and numbers. Everyone does technical analysis in their own way. I do it in a weird way. It's called the clueless 8 way. For me, it works most of the times, the majority of the times, and I'm okay with it. It's not something I just, came up with 2 days ago. It took me years to really figure out a lot of patterns. I have had experience in the markets, in the real world. I've been in battle of the financial battle on Wall Street. So you learn a lot. So I try to apply all that stuff and try to share it with you guys as much as I can. And we go from there. So one of the last thing I'll say is practicing and being increasingly disciplined. And the reason I say increasingly, because it's a learning process, right? For me too, believe me. So increasingly disciplined and keeping a pretty robotic view of what things are going on, gritting your teeth when when resets are going on, both on the upside and downside. And they're not happening at our time all the time, right? Sometimes it's taking a day, sometimes it's taking 2 hours. Sometimes it takes 72 hours, but it happens very fast. It's very hard and tough business, okay? And I want to impress that on anyone. And I'm saying that to all of you as a friend, as a colleague, as a warrior in the same battle that we fight every day, which is to win, make money to do what we think is necessary for people we love, to give, to donate. So the bottom line is that discipline is really, really tough. So I don't blame any of you. When I go, when I get tough sometimes, the Clueless 8 boot camp style, okay, one people to look at. Case in point is recently as last Thursday. I think it was Thursday, yeah. When when markets were overbought, kept on, pushing people to buy some hedges and stuff. And look what happened on Friday. At least on that part, when it came to the market indices, big, huge winner. Those calls which were being given away from $3-4, once it actually slipped below 3, they went to 10 plus. So the bottom, I'm sorry, not calls, the puts, SPX puts, because the reset was in order and it happened. One way or the other, it's going to happen. Exactly how it happens, the zigzag way down and stretching your patience down to the limit where they force you to sell and get out, make maybe a little profit and leave the bulk of it out there for the machines to win, is something that occurs all the time. So the discipline of not just say, oh, I'm going to hold on and praying, yeah, it's going to happen. That's not a trading strategy, please. So, but the discipline of really of staying with that trade, and on the same fashion, on the opposite, when things are deep oversold and they're taking a few days to turn, happened in Brexit, happened here, kept on showing what was going on. This is just one platform. But there are enough charts out there you guys can look at and validate my points. And keeping on saying, okay, here we are with the McClellan, with the one second, with the stochastics, which are very easy to really see, that things that they were still moving up despite the heavy duty volatility in the market. It takes a lot of discipline. So practice it. And as you practice it, it becomes less painful. Discipline is painful business. It doesn't come naturally. All right? I know that. It doesn't come naturally. And that's, you all know that. You go, smart people. But I got to tell you, if you don't have discipline on working every single day, mentally working, your brain is your ATM machine, not your hands. Your brain. Your brain will tell you what to do with your hands. This is the age of information. This is no longer the age of picks and shovels. So use your brain, you're all smart people, and use all the tools you have in your hand and win. But don't sit there thinking that, things are just going to happen. So saying all that, that's behavioral game theory part. I want you to keep in mind, as we go forward in the end of September, as we move forward in towards going into October, there is going to be enough volatility on the upside and downside to blow out traders right, left, and center if they are not truly focused on the heavy-duty technical aspects of the market. That's one thing I can guarantee you all. Okay? If you think it's going to be a one-way ride down just because it's October, and it's going to be a one-way ride up, you know, because you know, for whatever reason, both sides are going to be heavily disappointed. The word volatility is permanent. So at this point, what I'm noticing with the markets is, obviously, I'm not just noticing, it's, you know, it's manufactured. Believe me, volatility is manufactured, all right? Don't let the system fool you. They tell you, oh, volatility is good for the market. We have had enough volatility in the market, believe me. We just haven't had intense volatility. So we have had enough volatility. And they keep on telling you, every time you tell them, oh, volatility has arrived because everyone's back from the Hamptons. Like, what kind of garbage do they keep on talking about? But here's the best part about life. You can talk a lot of garbage, but the common investor out there believes it because it's coming from the media. It's coming from some talking heads who are talking their own books and trying to push down the market so they can make more money. You think Carl Icahn really cares if you get rich or poor? Think about it for a minute. Does George Soros really care if I can't pay my bills for my son's college? Does that make them bad people? No. Everyone works in their self-interest. But it makes them bad because they make it sound like it's an eternal truth. Bill Gross saying, oh, this is it. This is out of control. Everything's just going to crash and burn. Great. Have you seen Bill Gross's track record with the stock market? It's the worst. And so the point is that these guys are manipulating the markets for their own good. And that's human life. Accept it. Nothing's fair out there. So saying all that, the volatility is going to be very sharp. And what's going to happen is that the best constructed charts, and I do my best, and they work out pretty damn good. But here's the problem. The problem is they're not going to be as timely, but we will at least have a roadmap so we're prepared for what's coming at us. We know we're going to be hit with the, you know, force 10 tornado, or however, I forget, you know, what's the scale they use to measure tornadoes? What do you call, somebody knows out there. So it's going to hit us in 50 miles down the road. We're going to take action to protect ourselves. Doesn't mean we're not going to get whipsawed. That's exactly the stock market. Now, before, and going forward. So don't take anything at face value. Couple of market logistics before we get into the charts. If you play the indices, the SPX, the SPYs, the RUT, IWM, QQQ, the UVXY, that type of stuff, then you'll probably have a more cleaner read on the market, okay? Because you won't, you know, they're pure indices. They're, you know, they either go up or they go down or they go sideways and they confuse the heck out of us. But individual stocks will do what they do. They're just because markets were down. Look at what happened last week. Okay, we had, and as I'm talking through, I'm showing you, you know, different charts which we're going to go through. So we have had intense volatility. We had monster winners. Overall, people did very well. Many of you. And I'm very happy about that. Nothing makes me more happier when I hear somebody saying, hey, you know, I just did this. You know, there are new traders in here who are new to the business of trading, who grew their accounts, publicly posted, even in a difficult, heavy, volatile market that if you listen to CNBC or even Bloomberg or Fox Business or whatever the garbage that's out there, I shouldn't say garbage, there's a lot of smart people there, okay? But they're completely wrong. And there are people here, new traders, again, I repeat, publicly posted, so I'm not divulging any private information, who grew their accounts 25% this week. And God bless you for that. Should be running a hedge fund. because they can't make money for crap. And they keep on telling us that every day we're finished. You see guys on stock twits naming a huge public traded forum. Some of them are like painting pictures of 10,000 Dow. Hey, listen, at one point 10,000 Dow is going to come. It ain't happening tomorrow. So that's what I'm saying. Can make money through volatility, but most importantly, individual stocks, stock selection. And I don't have a staff of 100 people working for me. That's why my information is very pure, direct, and comes directly from the source, which is the 3 brain cells still left in my head. Okay, so but if I had a staff of 100, I would be pushing out the best the best ideas in different sectors. I try to cover what I feel are going to be the movers for that moment or for a swing trade, and as much as I can, I put it out there. Can't cover them all. I would love to, and some of them I'm trading on my own book. But I can't, physically put it out there on an ongoing basis. So bottom line is that there are sectors which are going to continue higher, dragging some of the best stocks within that sector higher. And then there are sectors which are going to be lower, all kinds of stuff. So this is a real stock market that you're dealing with. Okay? And I know it's hard for people to fathom that. People think that just because markets are down, everything's going to be down. Was that the case for the last month? For the last couple of weeks with us? No. We have had the biggest winners in the middle of really bad down days. Friday, the market closed down. I can't even remember. How much was the Friday the market closed down? Let me see here. Like 100 and... How much was the market down on Friday? Like 100 something, right? Yes?
I believe it was 130 on the Dow.
Yeah, about 130 on the Dow. So, okay. So let's say the market was down more than 100 points. It was a solid day. It was a solid day overall. So being a tactical trader, you need to rely more on the technicals than you've ever had in your life, and you will make money. Doesn't mean that you have to make money every day. I've said it before. Your P&L doesn't have to be green every day. If I know traders who always and wanted to have their P&L green every day, and I used to be like that. And do you know what the ultimate result was? Can somebody tell me?
Failure.
Yeah, it really was, because they did all the most stupid things, because their goal was not to grow their account, but to look at a P&L green every day. So they kept on missing out on big moves, because there's only a certain point that you can jump onto a running train, moving train. And when the train starts to speed up and you try to jump on, you crash. Unfortunately, bad things can happen to you. And that's, so the P&L doesn't have to be green every day. The P&L overall has to be green, in my opinion, from an accounting standpoint, every week. That would be a nice thing. So, and that's what we do here. If you notice, we go ahead and set up during real rough days, and we wait 24 to 48 hours, and we get the biggest bang for your buck, while what I call, no offense meant to the traders out there, lemmings, which most investors and traders are. They're lemmings. They're chasers. They're always after the fact because they want to feel comfortable. And by the time you feel comfortable, your potential of making money is less. Your potential is minimized. That's a fact. There is a very high price to pay for certainty. Buffett said that. And it's, I don't agree with a lot of the stuff he says, but I agree with what he said. It's true. You pay a very high price for certainty. Why? Because everybody knows that, and the price reflects that. They've bet with their money because it's a certain move, it's a definite thing, and then that's so I rather make the 150% and shoot fish in a barrel while the others are chasing and trying to buy crumbs for 50 cents. I mean, so for 10, 15%. And I've been doing it for years. And I learned the hard way. So the days which are the most painful, if they're tactically setting up, just because markets drop, you don't buy dips. Remember that, and you know that, okay? But if it's a tactical dip based on the things matching up, things that we watch and stuff, don't hesitate. Get in there. Yeah, you could be down for the next maybe 12 hours, maybe half the day the next day, but you're going to get a bang for your buck because resets will happen. And I know many of you are starting to become believers in that because you've seen it happen so many times and missed it so many times. You're like, you know what? I really got to start practicing that. And I know some of you are practicing that and doing much better. So, saying all that, let's look at a bunch of charts here because I was doing private coaching yesterday morning with two of our fellow traders, and we were analyzing what might go on. So first and foremost, a quick primer on this particular chart that that I put out there quite often, which is the algo chart. The first thing on the algo chart that you do is look at the lines, right? So you got the upper lines are your resistances, real simple. The yellow line, which I always kind of double highlight, okay, is your pivot. Very important, very critical. Machines work off pivots, a lot of them. A lot of these micro algos, the fast-moving day trading ones, the ones which are on meth. I'm just kidding. So the point is that, or bath salt, if you ask me, because the way they operate, I mean, it's crazy. So the point is that so here's a pivot, a very important line. Get your eye trained to look at that. Then you got the supports, right? And that's it. You got 3 lines here, 3 lines up here. And once we fall below, I mean, okay, so that's the first thing you notice. The next thing you notice is the structure that I draw over it. A chart is nothing without structure. Remember that. A chart is nothing without the structure you put on it. That's what puts things into perspective. Okay, here's my quantifiable risk, here's my upside potential, and then you can move within that. That is the most powerful weapon you have in trading, specifically short-term trading or even long-term trading. So that's what I try to do my best, is to draw the chart in a fashion over the price movements, draw a structure so that you guys can immediately zone in and say, okay, this is, I see what he's seeing. Now, the pattern stuff that we covered in last Sunday's session is critical. If you have a working knowledge on pattern, not pattern symmetry necessarily. Pattern symmetry is something you do by staring at charts when you're bored. Sit there for a couple of hours, get yourself some beer, some wine, and just seriously look at charts, and you'll see patterns. And those patterns eventually, they kind of talk to you. So that's pattern symmetry, finding a past pattern which matches what's happening now. But the actual chart patterns, the falling wedges, the head and shoulders, the consolidation channels, the pennants, on the candle side, the inverted hammer, the hammer, that type of stuff. You remember, an inverted hammer is negative and a hammer reversal is positive. So those type of things, just keep on continuously getting to be friends with them. And then the way I draw my charts will make a heck of a lot more sense too. But, so you do that. Then you start looking at, I'll go into the internals in a second. I'm just giving you the external part, which is the chart part. This, and the reason I'm focusing on this particular one, for example, on the quad algo HFT, is because this platform and this chart movements, the way they show it, has made me so much money. And without this, I wouldn't say 100%, but I would say 80% of the time, I wouldn't be able to call the market. You think I call the market because I'm some sort of, frigging genius who sits there and looks at CNBC and says, okay, market's down 150. I know it's going to go down another 20 points. No, I'm just looking at this, at one of this screens here, and this, and indices on this, or I'll show you charts. We're going to cover some charts today too, and stock charts, I mean. And I say, okay, this is where I think is my best bet where it's going to go, because that's what it's showing me. It's already doing the job for me. Thinkorswim does a fantastic job too. I use the Darvas box. I use obviously the moving averages are always there, but I use the Darvas box. I use the Bollingers. Then I use all the internals, and I come up with a quick, sensible tactical strategy of what to do. And off-market tops and off-market bottoms, my record is pretty spectacular. In the middle, it gets a little spotty because the market gets very spotty. It's tough to read. But off large inflection points, very few people can beat me, okay, on where we could get a possible powerful bounce, where we could get a nice fat sell-off, those things. Just keep on training myself, and I'm getting better and better and better. But you need the tools to do that, and this is one of them. So saying all that, look to see how I'm drawing the patterns. Look at all these other things that I put out there. A gap fill. This was a gap fill. This gap was filled, by the way. So I do take a little bit of extra freedom, I should say, or leeway to interpret it my way, because the purists believe that once a gap is filled, it cannot be reused again. I say, who cares? It doesn't really matter, because I've seen gaps which were like this was a large gap, right? That this got filled, but also becomes a major hotspot or trading range, or where we might fall in, despite the fact that was, just because something got touched once here on the gap side and retested doesn't mean we can use that again as a reference point. So I do. That's just my stuff. So let's go in to see, which everyone wants to know, is what is going to happen next week. Well, we start off with the premise we have no idea. So let's draw the picture. And let me say that it's probably going to be, I'm going to be right again on what might happen. I'm just basing it on previous times, seasonality, all that stuff. So, so we had this, before I get into the chart part, let's obviously look at the internals, or else we won't know what the heck we're talking about. So on the internal side, it's I make it, and these things take time. In the middle of a busy trading day, believe me, I'm constantly putting out these charts. It gets very cumbersome, but that's my job. That's what you guys all expect. So when I do put it out there, the least you all can do is to not just look at it, but try to understand it. Otherwise, it's a waste of my time, and it's certainly very detrimental to you all, because you won't know what the heck is going on, and you'll do the most stupidest things. Okay? So it works both ways. So one of the things I started doing is putting markers. It can't get any easier than that, right? So here you have the fast stochastics. The fast stochastics are fast. That's it. They reset fast, they move fast. Like I said, we could be down on Friday, we could open up after 6 p.m. tonight. We could have futures up 6 or 7. The fast stochastics could be overbought again. Obviously, I'm not just relying on this one platform. I'm looking at my Thinkorswim one too, and then I'm looking at the Warden one, but this one being the first one I look at. So gets overbought. Everyone gets excited. Market's opening higher. What happens in the first 20 minutes? They bang the market down from up 50 to down 50. A nice 100-point sell-off. And you're like, what's going on? Well, one of the things that's going on is the machines bought oversold condition, and they will sell overbought conditions. The overbought conditions are here. Now, is it a mandatory that just because something gets overbought, it's going to completely reset? No, it's not mandatory, but it's a very high probability move. But you can move, like this was Fed, right? This was the Fed day. Right there. The massive volatility, we did extremely well with that. You all know that, okay? It was fantastic. It was a great day. We caught the bottom, give or take, reversal candles, and of course you have to, it's contact sport, right? It's extreme sport. So I saw the turning, made some quick calculations in my head based on what I'm seeing on the other side, reading between the lines of what they were trying to say. It's not just clear cut, just, oh yeah, we won't raise rates in September. Okay, great. So that doesn't mean the market was going to rally. Could be interpreted in a different way. So I do that analysis too and mix it in with the technical part. So, and that happens to all kinds of economic news that comes out there. I try to make a quick estimation in my head of what might happen, look at the technicals, and then throw out my 1-line or 2-line comment and put in the alert what we need to do. So here you had the Fed day, the massive move up, the massive volatility, the pullback on the first part of the day, right there, and then you had this, and of course these candles don't look so beautiful while it's going on. And that's another thing I want to point out to all of you, which you all know, but it's good to be pointed out. In the midst of battle, which is the trading day, okay, between 9:30 and 4:30, things don't look so clean, do they? No, they don't, because in hindsight, everything's 2020. These candles, these candles are. One second. These candles don't look so beautiful while they're forming. They're all ugly ducklings. They're all chaotic, hyenas. Volatility is actually like a hyena, honestly. They're chaotic, but they have a purpose. They're scavengers, right? Volatility algos are scavengers. So basically, they don't look so pretty. By end of it all, that's why we do these sessions, because we can look at them and say, okay, this is how it developed. But while it's developing, that's when the MOHTR routine comes in. So we need to minimize our MOHTR routine. That applies to all of us in one degree or another. We cannot be monkey on hot tin roofs. Otherwise, we're just not going to go anywhere. So volatility algos are designed to make us act like that. So let's not be the monkey on a hot tin roofs with a chain around our neck, right? Because the machines want us to do that. So saying all that, you've got a very nice move up, which continued into Thursday, and things got severely overbought. So the markers. It got overbought actually here, but it continued because the momentum was way high. When you see a double candle move, a 2-candle move of this size, it doesn't reverse itself right away. Yes, it can, because it's heavy duty intense volatility. Yes, we could have had a large red candle here pointing down, but I'm giving you the higher probability move is that when you see these type of candles, when you see this type of, well, this was very methodical. This was this was back on the 12th, right? And very methodical move. You generally want to carry the momentum higher, and that's exactly what happened. And then when people started to get a little bit giddy with the, this market's going to hit 2,000 and, I'm sorry, not 2,000, I'm losing track here, 2,200, oh, it's going to be fast. You hear a lot of comments like that. You immediately start focusing on overbought conditions, severe overbought conditions. And lo and behold, those puts were bought in the midst of this mini euphoria up here with this somewhat of a spinning top naked bar. That's what it's called. It shows up more clearly on Thinkorswim. This red candle here, and I showed it in my chart too, with a big fat red arrow. And that's the reason why you have to focus on my charts. Choose not to focus on my charts at your own peril, and I mean that. That's good. That's a good suggestion. All right. So the point is that I put a big red arrow here, and then I bought the puts, and then by the end of the day, sold a little bit on the first move down. These 2 candles were good for about 30%, and then the market went up. It did this. That's what algos do. They don't want anyone on board, just the way they threw all retail and a lot of pros too. Why do you think we had a rally of this magnitude? Because you and me, I mean, not you and me. I mean, I didn't short the market there. I went long. But some major guys, they went short. And it was a very painful event. Very painful event. What happened after 2 p.m. It didn't start at 2 p.m. This move started actually more like, after 2:30 p.m. on Wednesday. It is billions were lost. I'm talking billions were lost on the short side. It's no fun. And that's the reason why the market squeezed them so hard and continued to squeeze them. Then came the lemmings right around this level, getting all super excited. And then came a nice, beautiful reset. Perfect for us. So here's your reset in motion. So they squeezed everyone out by 4 o'clock, and then came sorry, 23rd. Yeah, today's 25th. Yeah, that's Friday right here. So and so then comes your consolidation. Resets can be V-shaped, can be like this, or upside resets can be V-shaped or inverted V's, or they can be consolidation channels, which just fall. This can happen. This might happen by Wednesday. Just you all know that. All right. XPS 8300. Can I ask who you are? Please.
David.
David who?
David Tran.
Oh, okay. Hi, David. How are you? So good. So this pattern here that we saw with these two very large, and this is very important. This pattern symmetry. I'm going to make this simple. So you have this, have this. This was a monster move. It is possible, given given what we see on the internals by, let's say, Monday or Tuesday, that we get another move down like that to complete this pattern. What will this pattern look like? It's going to look like this, because this was the big Fed breakout, and this pattern could very well be resolved. I don't want everyone to freak out, lose their head. This is the beginning of that big wave down. It is simply going to be a violent correction. I'm going to show you both sides, all the probabilities. It'll be a violent connection. We rose here a couple of 100 points, right? Fast. We can lose 200 points fast and reset the market. So it becomes a screaming buy again for another tactical trade. Get it out of your head that we're on a breakaway train or a breakdown tunnel. Get away from that. We're trading in a trading range, period. You start thinking like that, you're going to make yourself consistent money. Stop listening to the garbage out there. Oh, yo, we're going to break away. This market's off to the moon and all that, stupid comments. And then, or we're going to fall into the pit. It's over. Trump's going to win, so we're going to lose down 2,000 points. It's all garbage. We're going to probably rally like 1,000 points right after that. So the point is that think yourself mechanically that we're in a trading range. And that's the whole purpose of these ACS things, to basically start to mentally recalibrate people's thoughts. So this drop, when and if it comes, as early as this middle of the week maybe, okay, by Wednesday. I mean, not by Wednesday. Let's say Wednesday. It'll be short, fast, ugly, and swift. So don't freak out. Just sit back, calm. I see any sort of major candle breakdown, I'll have some nice short hedges. I'm not going to get into trade management strategy today because I'll answer a few quick questions, because that's the next ACS. I'm going to really get in deep about trade management stuff and just share a couple of nuggets of wisdom that I have learned on doing things the right way. I never go lopsided on one thing or another. Maybe that's why I don't blow up. But how to do it in a strategic way, there's no rule of the thumb, but everyone has their own style, their risk level. But there are certain ways you can do it. We'll leave it for the next one. So the point is that, so this can happen. That's it. Now, will that, what will it, let me show you from a mathematical standpoint why it is that it's not the end of the world. So let me do this. Bingo. So here's a larger picture of where we are. This was the big trading range we were trading in. Let me pull this down. Good. Everyone has a clear view of the screen, right?
Yeah.
Okay, good. So here is a big downtrend line that we broke out of with some serious power on Fed Day. Right there. When you want to break out of a major downtrend line, as I kept on talking about, big time, you got to do it with force. You want to take down a big wall, and you have you need a very powerful bulldozer to take it down, right? Or a super duper jackhammer to take down something. So the same thing happens. These are known as breadth thrusts, high volume, powerful breakouts in the form of massive short squeezes, longs coming in, all kinds of stuff. And that's exactly what happened. So what we're doing right now is we tested, there's a couple of things going on. Once we did that, we created a gap. So I'm moving the gap line up here, right there. Okay? So the difference between this chart and the other one was running on real time. This one is a static chart. So we basically on Friday, what we did was we closed that gap and kind of held there. I'll draw the channels based on Friday's close. It's a real-time construction. Hold on one second, let me get this out. The yellow line is your pivot right there. So the pivot's at 217. Overall technical analysis, just so you all know, is absolutely dry and boring, but it makes a lot of money. So that itself takes that boring part away. So here. Because it's easier to tell a sexy story on a stock than show people and spend time on, sorry, I had to throw one of our cats off my trading desk again. So it's easier to tell people a sexy story on a stock than really show them the mechanics of how candles and all these forms work. Trust me when I tell you. Everyone wants everything simple. That's human nature. It's a great salesman in the world, which I'm not a great salesman, is they always, they're smooth. They'll sell, what do they say? They'll sell ice to the Eskimos. So here we are. So we are at a couple of major inflection points here. Let me just get this out. There you go. Okay, perfect. So just focus on this part here. This was your big breakout. This is the highs on the market. Let me get these lines away from here. This is the highs on the market going back somewhere in that 219 range, right? I think it was up here maybe. We'll see. So it doesn't matter. Somewhere up here. So when you look at this pattern here, we have a large, there's multiple patterns. I want you guys to focus on this. There's a large, this is serious stuff. There's 1, 2, 3, 4. It's a quadruple bottom. It's a quadruple bottom. At the same time, it's a cup formation. The cup went exactly to fill the upper part of this, lower part of this gap, which I showed in my chart several times, this gap, when it felt like the world was going to end, which was just the beginning of September, before it just ramped up again. This was the time you heard the cacophony of vitriolic chatter, all right? Fancy little words from all the big names, Bill Gross and George Soros and Soros actually has been quiet lately. What's it called? Carl Icahn and the Alpha. What's it called? Something Alpha conference. Where all the big hedge funds manager were like, it's the end of the world. Where Chanos is sitting there saying Alibaba is going to go to zero. In the meantime, he's lost probably $200 million. Okay, and all those guys. That was during this time. So they talk up the market. They talk down the market because they're getting richer off the fall and scaring everyone to stay out of the market. Then the market went back and did a very overall, it was we wouldn't know that here, but overall, it was a large dragon bullish formation. Also, a cup, and now we're creating a handle. For the bulls, this cup and handle has to remain intact, somewhere around here. We could come and retest the 34 moving average right there at 215. That's possible. But overall, the general shape of this particular large macro pattern going back to the beginning of September, first week of September, needs to stay intact. If this is the cup and handle, then we're going to get a breakout. That breakout's going to take us back to the blue line at that 219 level. That is a good possibility this week. It's the end of the quarter. It's the end of the month going into October. Markets have a weird way of manipulating investors. They tend to go fast and furious higher, and this is over a short-term basis. And the smart money locks in the profits. We do too. Before the market's going to have a nice corrective phase. So if that's the case, they want to jam the market up with window dressing, where portfolio managers are putting in the Amazons of the world and other powerful movers in the market, many biotechs included. Pump up the market by adding those, it's called adding alpha or excess return. I'm sorry, adding alpha or excess return by putting high beta names, high beta volatility names in their books. So the same stocks that work are the same ones that's going to work. So in the case of Amazon and stuff, it probably goes to 840. Somebody's like, oh my God, really? What's 5% for Amazon over a week? That's exactly what it is. So they will use those vehicles to move the indices higher. NASDAQ is already at new highs, while every single so-called guru out there told us that we were going to basically crash and burn on the NASDAQ. I can show you enough articles on that. So it's possible that we do that by the end of this week. Friday also happens to be the last day of the quarter and the last day of the month. Wow, how convenient, right? So one way or the other, it could generally speaking, as many of you have been with me know that well, the last week of the month, with the power of window dressing, with the power of the 800-pound gorilla, the multi-trillion-dollar mutual fund complex, adding some choice names in their portfolios or increasing stakes in those particular names, they don't care if on October those things pull back 15%, because once they're placed in their books by the end of the settlement of the 30th, okay, of September, when those mutual fund prospectuses go out and their quarter end report, which is very important. My first job was at Putnam Investments in Boston, right next to Fidelity at 1 PO Square. I got a great job. I used to park my boss's car. It was beautiful, actually. He had an amazing car. I have much better cars than him now. Just kidding. So anyway, so the point is that you learn, they get into this frenzy. If you work in a sales, you know you got to close your books at the end of the month, right? So you try to show some good numbers. The same thing with the mutual fund complex, which dominates, which are the biggest percentage of the market, as in holdings. So they try to do that. It's really quite simple. So they got to show some good numbers. So I doubt if we're going to have some sort of massive sell-off this week. We might have a good possibility, a sharp sell-off on Wednesday, or even start off on Tuesday. I don't know. Or if it starts earlier, the better. If we crash on Monday, we're going to have an amazing week. I'm just letting you know that. Crash meaning, get 100, 200 point type of pullback for whatever reason. That takes a lot of the fluff away right off the bat. But if the market continues, as I'll show you where I think the market will be by Tuesday, then you want to be taking some nice fat trading profits off the table. You don't want to be held hostage to what overbought conditions if it continues like that and ends up on Wednesday and you're like, what the hell happened? Because end of the month also gets very volatile. So if we do get the correction on Wednesday, it will continue through to the first part of Thursday, and then they're going to rush the market higher towards Friday close. That's just the way it works. You guys have seen it many, many times. I'm just explaining to you. So this would be the bullish case that we have this going forward, that we break out of this consolidation channel and all these levels, it basically goes like this. If the now let me give you the bearish case. Now, if the consolidation channel does break down for whatever reason, a consolidation channel doesn't mean it's going to be bullish. It's consolidating. They're profit takers coming in the overall market because they are the ones who bought these levels, like many of us did, and traded it actively. So that's a pretty big profit. So if this breaks down, we're going to, the first level of, and I'm giving you some broad numbers here. So the first level of support is this upwardly rising 50 and 34 SMA on the 1 hour, which is the trader's friend. You can trade off dailies all if you want, but honestly, daily charts don't make you the short-term money. It's just the way it is. Yeah, it keeps you in the trade, but it doesn't show you the volatility that comes along with that 1 hour chart or a 4 hour chart or a 30-minute chart or a 15-minute chart. It's pretty obvious. So here you have these lines cooperating. They crossed here. A cross of the 34 over the 50 is considered to be very constructive, and that's exactly what happened off the lows of the Fed lows, right before the Fed. Okay, so right there. I'll show that to you on the internals. It coincides pretty much exactly. So you have that, and these are the first levels of support. If they break, then we drop hard towards the lower Bollinger, which also happens to be, see this red line? I keep on talking about a retest of the DT line or the downtrend line. You could get a retest of the downtrend line. That's the bear scenario. All right? Doesn't change anything. This is massive support, 212, around this level. This is a very strong support level. Is it possible that the market does this again and moves? Absolutely. You're trading within a range. You're trading within a range. Do I think this will happen this week? I think the probability is low. Do I think this will happen quickly in the first part of October? Yes, I do believe that. I think they'll come back and let me get these lines out. They'll come back and retest this level on the SPYs, SPX. I'll show that next. So there's your bullish scenario, large cup, handle, breakout. Where's the breakout? Not to the moon, like you hear a lot out there. Up to the upper Bollinger. That's your first level of resistance. You have multiple resistances along the way. Or minimum to the pivot, right there. The pivot's somewhere at, the pivot is, look on the right side, is at 217. Yeah. So could it be a pivot failure? Absolutely. But I think the market, just as a magnet, that's just the way things happen, wants to go back and test that pivot. That itself is some decent money. We closed at around 216. You get another 10 S&P points or so, roughly 1 point on the SPYs. That's decent money. 10 S&P points is almost 60, yeah, 60% plus on your money if you're playing the SPXs. Not bad. Don't have to go crazy. Small amounts. Small gets big in this market. I've shown that repeatedly. So that's where you are. We are already, I repeat, we are already at the lower support here. So any break below this channel will cause a quick drop, fast drop to test these lines. As long as these lines, and it's really as simple as that, as long as these lines are trending higher, the 50 and the 34, we're going to be okay. If they trend lower real fast, and the only way that's going to happen, can somebody fill in the blanks? Only way moving averages make a U-turn down or U-turn up is when what happens?
Large red candles.
There you go. Thank you for the answer, Corey. You're getting it, man. Exactly. You need a thump. Either a large red candles to turn them down. Already we got these big fat breadth thrust like that, rocket boosters, like I used to explain way back. That the shuttle it's not that big of a plane, but the boosters, when people look at the shuttle taking off, the booster is 3 times the size of the shuttle and is below the shuttle. That's your liquid oxygen, liquid nitrogen, or whatever they put in there. That booster is needed to break out of Earth's atmospheric, pull, gravitational pull. Same thing with markets. Markets are natural. All right? So you get that big move, you broke out, you created a big crossover. Very nice. That crossover continues despite the fact that we have had this consolidation channel. We have had a nice consolidation channel. Some people are pretty freaked out. They're already singing that, 2009 blue, this is the beginning of the thing. Don't bet on it, okay? The bottom line is, despite these pullbacks and all that stuff, so far, the moving averages continue forward on a short-term basis. And that's a good thing. Once, like Corey correctly pointed out, if you get 2 red candles like this, the first level of support becomes the retest of the downtrend line down here. I'll be showing all that on real-time basis anyway. So next time you look at the chart, it's going to make a lot of sense, a lot more sense to you, some of you. And if these lines turn down, that means we're seeing some major selling pressure. At that point, things will get deeply oversold, and we'll see one step at a time what happens from there. Now, let's take a look at the internals while I explain to you all the externals on what's going on, which is the price chart. This was Friday, big sell candle, pretty much. This is your stows. We are oversold again after being overbought that I kept on warning people, and in my own clueless way yelling at people like, why the heck didn't you buy puts? Like some a bunch of people didn't as a hedge, because it was pretty obvious that we would reset. That's a real decent money, almost 200% plus. Not bad. Small amount of money can, get pretty, get some decent return. Not decent. Those 200% is an indecent return. Okay, let's face facts here. Let's not be so politically correct. We get all kind of enamored with the fact that, it's 200%. 200%. Come on. That's real decent money. Maybe I'm very humble that way, but to me, getting 100%, 200%, I mean, these are staggering numbers. So let's not fool ourselves here. How many times have we had trades which a lot of people have missed, and they're up like 200-300? Look at Chipotle. I know I'm harped on it, but I'll say it. It's like $1.40, $1.50. It slipped as low as $1.20. They went to $10. I'm sorry, they went to $11. Holy cow. No, they went to $10 and change. That's 800% or 900%. Yeah, 800%. 800%. I mean, come on. It's like we I don't know, we're jaded. What do we want? Like 1,000% every 5 minutes? Yeah, in order to do that, you got to take some risk. It's happened. So saying all that, this is oversold. Let's take a look at what's happening here on the hourly. The fastos, I'm sorry, that's the fast stochastic. So they're in oversold right now. No question about it. Looking at the slow stows, we are somewhere midway. We're at 46. We're 46. So we still have room to fall, to get really oversold. Once, and I just want to say this, I shouldn't say once and for all, because knowing me, I'll keep on repeating myself because I want to help people. Repetition is good when you're trying to help people, when you're trying to teach people something. When you get down to these horrific levels down here, okay, you don't have to read the numbers. You can visually see it, okay, but somewhere in that single digit range on the slow stows. And this is specific for quad platform users, and everyone should try it sometime, okay? If you like it, keep it. If you don't like it, dump it. But, I'll put the link up there. Well, actually, it's on email. Anyone interested, let me know. Call them up, try it out. I mean, these are fantastic trading platforms, especially for active traders. So here we are. Once you get down to these levels here, it's a screaming buy. And that's when people get like, oh, you feel the silence in a big way. Natural. Human beings are like that because you probably, none of us are right every single time we're buying something. There's a whole bunch of times I'm sitting on losing positions, but I'm cost averaging down. Now, some of you might say, and that's fine. Everyone has their own style and discipline. Oh, I never cost average. To me, that's complete hogwash. If you don't cost average, then why are we trading a volatile market? Then maybe we should just wait around and just wait for these monumental events to happen, like the market going to 2,300 or market going to 1,800 to sit there and buy. If you're going to be a trader, you got, in my opinion, got to cost average. The reason why that term was said that, people who cost average are fools, in the old days it was correct. Because in the old days there was a pattern run by humans. Now it's machines. They're constantly resetting back and forth. That's what we do all day long. So if that's the case and you bought something, let's say the initial position at 4 or 5, and now it's at 2 or 3, yeah, of course you got to have your, pain threshold. But if you bought a small position and you're seeing that everything's getting oversold, I do. I'll go and buy and lower my cost, and then within 24 hours, within maybe 2 hours or 3 hours or maybe the next day, I'll be just like shooting fish in a barrel. It happens all the time, both on puts and for calls. Puts, it happened on Thursday. I bought my initial put, sold a little bit, held the rest. The rest went from somewhere around 5 to 6 to $3 and less. I bought more because I saw how things were getting oversold, and I made a probability bet. So by the time all is said and done, I had a reasonable position. Nothing crazy, but a reasonable position. Those same puts went to almost 10 plus. Did I hold it all the way to 10 plus? Absolutely not. I sold more. I sold the bunch around 6. That was 100%. Posted it. Left a little bit out there. Didn't chase it. Just let it go. Markets fell. Beautiful. I even mentioned puts on the system. So and this is just one small example of cost averaging. Doesn't say everyone has to do it. Do whatever you need to do. But in a volatile market, you have to do it. Otherwise, you're not going to go anywhere. Because, yeah, go ahead.
Hey, Frank, sorry to bother. This is my real question.
Go ahead.
When you dollar cost average, do you do it on the way down or do you buy it on the way up? When you dollar cost average.
Terrific question. Both. In a high momentum move like we saw after the Fed, I kept on buying more. That brings me to my next point, which will answer this clearly, Corey. And that's a great question. I do it on both sides. Okay? You can cost average up. Just because I bought something, maybe I bought too little. It's happened. Why should I give back you on these biotechs, which Corey you'll relate to? I kept on buying more as they burst forward. When it came to Allergan, which was one of the best trades I'd done in a while, from the way down there. And Corey, you remember that well, okay? I kept on blasting, buying, cost averaging up because it was just moving fast and furious. So if it's a high momentum stock or a high momentum breakout on the market, movement on the market, candles, if I bought a little bit here, why wouldn't I add it? Because it's obvious to me that that when I see the second candle developing, why wouldn't I buy more here? Doesn't make sense. So it's up to each person. So I do it on both sides, which brings me to a very important point: momentum. Traders don't seem to understand the power of momentum. Can somebody tell me what the human social definition of momentum is? Aside from Newton's law that a body in motion stays in motion and a body at rest, stays at rest. In the case of markets, when it comes to emotion, what does momentum signify? Let's say momentum on the upside. What does it signify? There's a term used in investing circles and on Wall Street. What's it called? Anyone take a guess?
Breakfast?
No, that's a technical term. I'm talking from a social level. It's called animal spirits. Okay? You know how you get into that zone as a trader? Tim, I'll answer that in a second. No, it's not a swing trade. Momentum has nothing to do with swing trades. Momentum has to do with force. Momentum, this is what momentum is. You made some money. You're feeling so friggin' good. You want to go in there and trade that, trade that stock again to make more money. It's called animal spirits. Traders fail to understand the power of momentum. The reason they fail to understand the power of momentum, specifically retail traders, machines understand that, believe me, okay, is because of their insecurity and fear. If, there's my dad, long time ago, God bless his soul, has passed away. He used to say, what would you do if you knew no fear? And that was a famous saying by somebody else. He said to me when I was a kid, what would you do if you knew no fear? You would do things that you can't even imagine. Your brain would move. You would make so much money. You'd take every one of my trades and your own and triple it and quadruple it repeatedly because you wouldn't have fear. Now, is that kind of stupid sometimes? Yeah. But at the same time, fear is what stops us from making the most amount of money by doing stupid things, selling for a little and then telling ourselves, because we all have to justify our little brain, right? Oh, well, next time, oh, I made some money, so it's good. No. If a market is going to move up 300-400 points, tactical charts are showing that, all that kind of stuff, you got to take an aggressive position. So when it's reverse of the Fed like that, I looked at the previous pattern. I showed people. It's not that I look at it. I don't share it with anyone. I share it. Okay. I looked at this. I looked at previous Fed movements of what they did, and I knew this was going to be a blast up. 2 levels, which I explained very clearly. I said 2170. Everyone remember that clearly? Yes?
Yes.
Exactly. Where did the market go to? The market went to 2170, 375. Whoopee. It went up 3.75 points higher than what I said. Now, why did I say that? Just off the blue? No. I looked at the gap, and I said we're going to get to the lower gap fill. The way the market was moving, it looked like it wanted to get to the upper gap fill pretty much right away till I saw the reversal candle. That's when I said, okay, time to get some hedges. So it's calculative. It's not just emotional. But the power of momentum cannot be denied. And the more you practice it with small amounts, okay, that's the best way to practice things. You will understand the power of it. When I bought those BSPMs, when I buy those things, and when I buy those little ones which go up 60% in one day, right? I'm playing on pure momentum with some technicals added to it. I'm not going out there putting my whole account in there. I'm just taking a chunk, I mean, something's at 276 and it's really like shooting like the 3 candle move and stuff. Why wouldn't I buy a couple of thousand shares? And somebody can buy 500 shares, somebody can buy 1,000 shares, or even 200 shares. I don't care. You're going to make money on that. So the power of momentum is critical and must be respected in this type of momentum-driven markets, both on the upside and downside. So I can't teach you that. You'll have to learn that on your own. But when you see momentum on stocks like Amazon, you see momentum on stocks like Tesla, which matches with the technicals, you got to be in there. You got momentum on these biotechs, right? Sarepta, which was more of a tactical play, mind you, because we sat on it, kept on charting it. Everything was still in place, even though, it was down a couple of days, up a couple of days. It just, and then it broke out. When you have momentum on your side, like momentum stocks, you can see it. The candles kind of place themselves up, and we're going to look at those quickly. For example, this Puma Biotech. Okay, biotechs have an extra risk, which some of you know very well, which has to do with their inherent risk. It's a biotech. A negative trial, a disapproval from rejection from the FDA, all kinds of stuff. But aside from that, when you see multiple repeater candles on a daily chart, okay, that's animal spirits in play. So on a stock, you can play it short term, make the money and pull it back, and then see what then decide whether or not long-term chart is fine. But in general, you have to respect momentum. That's why I say respect the candles, red candles and green candles. So that's, and momentum investing is powerful stuff, and I'm going to show you something here. So anyway, so explain this. So this is oversold. This is not fully oversold yet, but I'm going to show you a trick. This is why I like this platform a lot. Let me take this out. So if you just looked at this, you would think, oh boy, we're halfway there, and looks like there's a nice little drop coming. That's the slow stochastics we're talking about, right? So now I'm going to put this chart on real-time mode. See, it says pre-post market data. Bingo. Beautiful. Beautiful. What happened to the STOs? The slow STOs are oversold. Because that was static data. This is dynamic data, taking into account pre-post market trades and all that stuff. So where are we? This is where I said short the market. Right there. Look at the cursor. Right around there. Yeah, it went up a little bit. So with this little movement up, didn't bother me. I saw the crossover. It bothered a bunch of other people who probably sold their puts because they're just like, oh, no, we can't do that. Market's going up. That's the fundamental flaw of just looking at prices. Prices are meant to be manipulated. Internals are which move with price, but are more difficult to manipulate. Prices can be manipulated with a fake 100-share trade. Yes or no?
Yes.
Right? Exactly. Algos do that all the time. They are borderline scumbags, some of them. They spoof the market all the time. The SEC still hasn't been able to make that fully illegal. Maybe one day. When they spoof the market, they're doing exactly what the word means. They're tricking the market into giving out fake price discovery. Maybe 20 shares or something, and they do it, and they're not like, money in the old days, market makers, the old guys who sat there in the back room, who used to take the half and the quarter and stuff. Those were the glorious days of the New York Stock Exchange floor when they made millions of dollars being floor brokers. They all went out of business. You know that, right? And most of them. I had a neighbor when I first moved to Wall Street, got a nice little place, don't want to be like 5 minutes from my office, all that stuff. Guy was, he's a great single malt Scotch guy, so he liked me. I was like, okay. So he was a $2 broker. I said, what's a $2 broker? And so he explained to me the whole thing. All right. The spreads that they made on stocks, because they were the market makers, this, doing the price discovery, what a buy, a bid and ask would be, was huge. But now machines have taken over. So that's the good part of high frequency trading. They have reduced costs for us to trade. The spreads are generally very tight on individual stocks. Who are the biggest bandits in the market right now, which has still not been fully automated? Tell me. We do it all the time, and we always complain on certain stocks. Come on, guys. What do we do? What type of trading do we do mostly? And then, no one? Yes, Kerry said it. Options. Okay? Options. Option makers. They are the worst bandits in the world, and they are right there mostly at the Chicago Board of Options Exchange. They're a bunch of, excuse my French, scumbags. They are stealing money from us every single day. When you get a bad option fill right at the open and the stock is up a lot, Who do you think is stealing from you? Santelli's boys. Gotta look at the truth. It's terrible what they do. The spread is like freaking $3 wide. Is there any reason why? Oh, they'll say it's a liquid market. Garbage. Allergan is not a liquid market. Sarepta is not a liquid market. So why are the options are frigging 30% wide? In between the bid and ask. You guys ever think about it? And he's talking about equality in America. That guy standing there. I'm serious. I know this stuff. I'm telling you. And all his boys are stealing money from us every single day because we're not getting the right fill. Has it not happened to you when a certain stock, like especially known stock, like the one which I had the most difficult time ever selling, even if it was up $40, and I'm up like decent amount, very decent amount. But I'm trying to get a price, and they're totally playing around with me. Was Intuitive Surgical, ISRG. Many of you know that's been one of my most powerful earnings play, which I've been correct on, ISRG. And it's a $50, $60 mover. I buy some. I know I buy deep in the money calls. I mean, not deep in the money or in the money. So I'm paying them maybe $11 or so, a couple of them. And they open up at 30. They open up at 40. I can't even get a fill at 28. That's the logistics of the market, because those scumbags sitting out there in the Chicago Board of Options Exchange, in the Philadelphia Exchange, which are still humans running, making the markets, they are, stealing and screwing us every single day. You don't believe it? Look at all the bad fills on options that you've gotten over the last couple of years. Do you guys agree with me or not? Yeah, exactly.
Absolutely. I never really thought of that.
Yeah, that's my job, is to open shed light on that. They constantly do that. You try calling up Thinkorswim or Scottrade or wherever you're trading, and you say, hey, listen, I got a bad fill. I saw the answer, oh, let's call down to the floor. They call down to the floor, and that scumbag standing there behind Santelli or whatever, making faces and all that. Those guys are a bunch of idiots, I swear to God. They have no idea about markets. They are a complete bunch of bandits. They got to make a living. So to them, stealing from us is no big deal. And they scream and shout about everything else that's wrong in the USA. Seriously, it pisses the crap out of me. They're a bunch of complete highway robbers, and they've stolen so much money from me in the form of giving me bad fills here and there, even though I made money. Their justification is, hey, they made a lot of money. They bought the call at 11. Now they're selling it at 28. I should be getting 36 for that call. So you're just, it's like this communist and a bunch of frigging socialists who say, oh, yeah, he made too much money, so I'll take most of his money. I'm the one who put my capital at risk. So just because I want to get the right fill at 36, let's say if the spread is like, seriously, the spreads can be very wide. You guys know that, especially in biotechs too. You're telling me that I shouldn't get my fair due, that you have a right to steal money from me while you just sat there and just tweaked the price around? Telling you the truth about what goes on with this stuff. And the only way so automated options makers, which are starting to come, but they're being fought, obviously, because all these scumbags want to keep their lucrative highway robbery business going, okay? So every day, it's highway robbery. So the bottom line is they, especially when it comes to spreads and stuff, we're at the mercy of what they're doing. Whichever the case, Sarepta, for example, we made a bunch of money on that. But when the stock was going up $1, $2, $3, the options weren't even moving. They weren't even moving. But I kept on rolling them out every week. They were terrible. They weren't even moving. Stock would be up $3. It moved maybe 50 cents. But the automated ones, which are much more, I shouldn't say liquid, but much more effectively managed, are the Teslas, the Apples, the Netflixes, the Googles. You see the spreads are tight, and you can basically go in and out. It's an efficient market. So as options players, we have to be cognizant about these things, So let not Santelli tell me how fair he is, because he's one of the he's running a whole horde of bandits, okay, who are doing this to us every single day. So saying all that, and this is nothing personal. I'm just telling you the way they do things. So let's take a look at what is going on now. So this is a 1 hour chart. This is looking damn good, guys, all right? By 6:15, when futures are fully trading, all right, you can verify, did you add to SPX expiry 9/23? What's he asking? Tim's asking, can you verify, did you add to SPX puts
Yeah,
expiration?
you were saying on Friday you dollar cost average
No,
down
I
on
didn't.
Friday.
I didn't dollar cost average down. Think what I said repeatedly. I said I dollar cost average on Thursday when it went up against me after selling
Oh,
the
okay.
first lot.
Did
Okay,
you do
yeah,
anything on Friday?
on on
Did you?
on Thursday, and then on Friday I did multiple trades. I am not short the market right now, if that's what you're asking.
No. I'm
Go ahead.
talking about the trade on Friday. Uh,
Go ahead.
we were short on Thursday, right? And
Yes.
then go into Friday.
Yes.
I was trading for hours and basically the theta burning, so I could get out for a little bit gain, and after that I'm done. And then I did go long on Friday, and I still long. But
Okay.
I want to know, how did you trade during the day on Friday on the SPX?
On the
No,
SP
SPO.
on
Yeah,
on the SPX, I had my SPX puts.
right.
And so those SPX puts, I explained earlier, I sold them on the staggered way up. So I only had a small portion left by the time they crossed over $10, which I which
Okay,
I which I got rid. Yes.
okay. So, but
But
you did not add in anything put on Friday.
I can't recall that off the top of my head. Yes, I think I
Okay,
did add, if I remember correctly. I mean, you got to scroll down and see on that. I can't remember on the top of my head. I don't think I
okay,
had any major position on the put side on that side, because we were doing, what I was doing was more importantly protecting profits on a bunch of stuff that opened up very, very nicely, and the CMGs of the world and stuff like that.
right.
Yes,
Yes, okay.
exactly. So
Well, like I said, the on Fridays, oil was dumping, and the SPX hold basically very steady, just ripping until Apple dropped, and it touched.
Correct. Yes, that's
Yes.
right. The Apple drop, which was a gift, because
Uh-huh.
to me, buying those lottos first at 20 some cents and then at 11 cents and selling them at 36 cents within a matter of 10 minutes. See, the Apple drop, yes, but aside from the Apple drop, there was pressure on the market from the energy side and such, even though specific sectors not specific stocks that we're trading in, and I kept on saying add on them, was doing fantastic, and Twitter was a home run on even for people entering on Friday. Twitter was a home run. It was 100% on the first alert that I put out there. The second alert was up 50%. What more can I talk about? And we were not even trading the ones expiring that day. We were trading the ones, as you know, trading next week. So we were busy doing that. So scrolling back on Friday's trade ladder, there was a bunch of stuff that I was adding on the swing side, like the four biotech picks that I'm focusing on big time right now, and Twitter. Apple was a very fast trade, a very profitable one, and of course the SPXs were more on the oversold side, so I wasn't pushing my short trade on that. I wasn't intraday. I wasn't pushing the short trade. I just had stuff left over from Thursday. Okay. All right. So let me get into this right now, because we need to start wrapping up. So here we have, this is very real critical. We have a real-time, full-blown oversold condition and a possible crossover of the slow stochastics. This signifies that we might overnight, if we have a big pop on the SPX for whatever reason on the E-minis, this could very well get up somewhere up here. This is the slow stochastics. The slow stochastics are always, almost 100% of the time, a sell, depending on market levels, of course, a sell when they get up above in this 80 to 100 range. Period. At that point, you cannot push your trade, and you're basically looking to scale in, which means cost averaging, doing whatever you need to do, or not going in all at once on the sell side. It's really as simple as that. So next time you see when I put in the charts and I'm saying, okay, these are tactical buys on the slow stows, they are buys. Now, will it happen right away? We all like to happen in the next 5 minutes, but it doesn't work like that. They'll zigzag its way up and get overbought and get me my returns on my money. But in the meantime, you'll see red candles. This was a reversal candle. Ended up here, right? But what did it do right after that? It threw people off the block with this red candle here. But what was the eventual trade up here? So these are things, you guys gotta figure out your thing. I'm talking about reading the underbelly of the market to see if this continues higher, if the slow stows continues higher as it was doing here through all this volatility, okay, all this volatility. Remember, this was the Fed. Now, please listen carefully because this is the most critical part of this session. This was what was happening before the Fed. So if you're just looking at the price action, you're freaking out. If you were looking at the internals mixing with that, you were freaking out less because it wasn't unknown what was going to happen. So saying all that, look what was going on with the slow stochastics. The slow stochastics went up, got overbought right here, hit the top of the Bollinger. Train your eyes to look at the Bollinger, hit the top of the Bollinger, because what we were doing was we were moving in a trading range like that, top of the Bollinger, lower Bollinger, all this stuff. So we got to the top of the Bollinger. There, look what happened. We hit the upper level, not fully over, but upper level of the slow stow. I show all this stuff, so you don't have to do it yourself. I'm showing it. Some of you are using the platform. You can do it. You can just train your eye to look at it. So right there, we get a pullback. That was it. That was a pullback, and the slow stows came down here. This pullback was pretty fast before the Fed, by the way. All right. So the bottom line is, or maybe this was after the Fed. I can't remember, but during that period, during that 2 o'clock period. But I noticed that the slow stows didn't come crashing down here. That told me something. And this line that I had drawn, and I always do that as a point of reference. This uptrend line, okay, that I had drawn previously was not breached. I stayed more on the long side. So I added a little bit more, and that was a 200% move on the SPX calls. So the slow stows, as long as they're pointing up and moving nicely, you stay with the trade. Doesn't mean it's going to be comfortable. They're not going to be up every single minute. But generally speaking, this is more of a swing trade type of thing. Not for days, for 24 hours, 48-hour type of thing. So if it stays there, you stick with the trade every single time. Now, these were very fast. These resets were very fast. They were all happening within 1 day, these ones. So if it stays there, you stick with the trade. Once it gets back up here, it is going to reset, period. Now, let's take a look at there's no ifs, for, buts. That's what it'll do. Now, let's take a look at the Fasto. The Fasto right now, going into Monday, futures haven't started trading yet, is oversold, bouncing around the bottom. This generally bounces around the bottom like this during a consolidation period, like we're going through right now. If we break below the consolidation period, a channel that I showed, and we start to fall, let's say futures, open down 6-7 points, and we keep on heading down, this thing will basically just go like this again. It'll stay below the 20 level, suggesting weakness. If we have a red candle at the open tomorrow hanging somewhere in midair, the market will hit hard and fall 100 to 150 points tomorrow at the open. I mean, at Friday at the open. Yeah, tomorrow at the open. Not going to feel good because I have a small amount of SPX calls, plus I have positions in individual stocks. Everything is going to get hit at the same time. So, but once it gets down there, in my opinion, this major support level in the market is going to come into effect in a big way, or it's going to re-engage. And we should get a very sizable bounce getting back towards the upper end of this consolidation channel and the gap fill. And that is a lot of money. If we open down here, it is, in my opinion, unless you're very fast, you short the market, they will squeeze you. They will hurt you. unless there is a fundamental reason. I mean, the reason, the macro reasons matter. If there is an economic event and stuff, that's a different story. So that's the way it works. Now, another thing that I want to show you real fast is, and this is an indicator that I've been using. So this is really good. It's oversold, so that's positive. I like it. Love buying, deep oversold conditions. And this is something that is very interesting. Okay, this is known as the SMI, Stochastic Momentum Indicator. Now, listen carefully. It's not hard stuff, all right? The stochastic momentum indicator, on one minor consolidation, right, on Friday, is back in oversold zone. Gotta love it. Because once it gets down here, you do get an inevitable reflex bounce. Like that. Like that. Always off the bottom. The stochastic momentum indicator is measuring momentum of the stochastics. All right, so this is good. It's oversold. Look where it was when I was telling everybody to go out there and short the market to a certain degree and buy hedges. Despite the price action, which came down and then went up by the end of the day on Thursday, threw a lot of people off the block, off the trade. They're like, oh, look at the price. It's going up higher again. Who cares? The so-called smart money and the machines were just sucking you into a bear trap. And that's why Friday was so lucrative. I'm going to say a bull trap with manipulating the prices. And then come Friday, it was a nice, nice bang for your buck. I know people who basically sold out for a minor loss or flat on Thursday afternoon on the SPX puts. Live and learn. You're learning now. So once you start to see things topping out, you want to be tactically short. Once you see things stop, reset, you want to be tactically long. I'm talking about the indices here. Quick thing. I'm going to move to the daily. And this is what I like a lot. On the daily, don't worry about all the dots and stuff. Look at the SMI here on the daily. Stochastic Momentum Indicator. Let me get these.
Hey, Frank, does Thinkorswim have that indicator too?
SMI?
Yeah.
I don't know, actually. They might. I'm going to check. See, I can't put way too many indicators on a chart, otherwise the chart looks so noisy, you guys won't even figure out what the heck's going on. So this one is very clean. This is what I like a lot here. Look at the spies here, okay? Look at what's going on with the shape of the internals. And once you start to do this more, you guys, this is easy stuff. Hard part is managing the trade. This is nice. Despite all that volatility in the market over the past, in September. This is September, right? Look what's happening here. Look what happened here. This was Brexit. This was Brexit. Now understand the power of what's going on here. Do these patterns look somewhat similar? Yes or no?
Yes.
So if that's the case, and we don't know, it's a probabilities game, right? We don't know yet. So if those patterns are similar, this was Brexit, and this is what's happening now, and we have had enough volatility now, there's Fed speakers, all kinds of, we know it. If these patterns are similar, what is this telling you about the market? Just based on pure pattern symmetry of the internals, the stochastic momentum indicator and the slow stochastics, two very powerful indicators. If these patterns are similar, what happened here? Come on, it's not a difficult question.
Went up.
Went up, and went up a lot. So the bulls, the bulls will argue that if you look at pure robotically looked at the internals, the market's about to bust a move. And what is that bust a move? Up 2,200, and this time they ain't stopping there. They're going to overshoot. They're going to overshoot to that 2220, 2230 level that I talked about months ago. That is a good possibility or a good probability of a move happening by Friday or by the first week of October. Mid-October is going to be dangerous on bias to the downside. My opinion, I'm sticking to it, seen it happen before, and the technicals are also telling us that. So before that happens, what do you think the market wants to do? It wants to get overbought, suck a bunch of idiots into the market, and then slam the market 500, 600 points. That's exactly what they're going to do. So whatever we do, we have to keep these things on the back of our head. So looking at the internal patterns, this is definitely positive. There's no thing, it doesn't mean individual stocks are not going to do their funky stuff. I'm talking, I'm talking the overall market picture here. Very, very important. And I'm going to be tracking that, and I'm going to be moving from that and see what happens, because this is very. Can it create a double bottom? Sure it can. Whichever the case, if this momentum continues, and I drew a channel here because this is from yesterday's ACS, I'm just doing with two other people. So if we get to the upper end of the channel, forget about getting overbought, even the upper end of the channel, that should take us to 2200. And that should bring us the slow stows up to overbought conditions again. And once it gets overbought there, and I keep on pointing out, you do what you need to do, but that's not a point to get super excited about anything. I don't care what CNBC is telling you, what StockTwits is telling you, what the sweepers are telling you. It does not matter. Technicals precede fundamentals. And that's the way it works. So now, I'm just going to open up for a few minutes worth of questions so I can address that. Jules, anyone? Corey's always got good questions.
Here, I got one on, I was asking last week on tick. What can we use to learn anything on there on the breadth of the market during the day when you're trying to do something?
Okay, I'm not a tick specialist, but I look at it all the time. And the way I look at it is that when you have, when you basically, look, people who trade on ticks, they are just so fast moving, right? So what you can learn from it in a broader respect is this. When you see a tick below 300, below 100, like a minus 100, minus 200, minus 300, that means the selling is accelerating. Once you see it towards the minus 700 to minus 1000 range, a tick flush, as I mentioned it, is roughly a 900 to 1000 negative. Okay, so minus 900 to minus 1100 is a major tick flush. At that point, major stops have been triggered. People are freaking out. You get a spike in volume on the sell side, and the market generally, after a major tick flush, tends to reverse. So on a heavy selling day, I watch the tick. It's always there. It's on the side. I watch a whole bunch of indicators. I'm watching the advanced decline line. I'm watching the tick. I'm watching the trend. Those are the other measures too. So when you see large, ugly red days, and you see that the tick basically have the best way to look at it is as it's accelerating down, minus 300, minus 400, because it just moves so fast, right? And then it goes to anything below minus 1000 is known as a tick flush. I am not an expert on tick, I'll tell you that, but that serves me well because by that time I see on my own side of the indicators and stuff, things starting to basically get deep, deep, deep oversold. Same thing on the upside, you get a large tick move up, plus 500, plus 600, plus 700. You know the market's getting, at that point it's got that little juice going and everyone's getting a little too excited. If it matches with my technicals that it's getting overbought, obviously that's a sign that they're going to smack the market. So that's the best way I can describe it. But the tick flush is what I really watch for, which is on large red days. And as things start to get really you get a lot of wowzers in the room and a lot of, whoa, 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 look at that. Oh, here we go, and then the CNBC's like, we're going through, the markets. They bring in a couple of the real hardcore dogmatic bears. Ticks going down and down generally is a damn good sign that we're getting to a tactical viable zone in the market. So that's it. Any other quick questions?
I got one last one. I heard that if you have 1,000 negative drop, you can really stay in the market that day and keep buying more puts.
If you get 8 what? Oh,
eight 1,000 negative drops,
Okay.
right? Then that day you know it's negative, and you can just start buying the hell out of puts.
Buy the hell out of puts. You mean short the market more?
Yep.
Okay, so there's a reasoning behind it. It means that if you're getting that kind of buying climax, it doesn't end in one day. Like I say, if we get a large, ugly day on Friday and everybody wants Friday to be, this makes a lot of sense. Everybody wants Friday to be positive. You hear that a lot. I hope the market ends up, flat to higher. No, that's the worst thing you can do. So bottom line is you want the tick flushes to continue like that, hard down. You want the following Monday to open lower like we did 2 Mondays ago, and that's when you want to start buying hard. Or you buy a little bit on a Friday close at the lows. You know the market's going to open down 13, 14 S&P points, on a major move down on Monday morning. You won't get any time to add to your calls if you don't move fast enough, because the reversals are so fast and so furious. And if you want to get a good price, do you honestly believe that the market gives you a good price on a reversal hammer? No, it doesn't. I moved my head 1 second. The SPX call that I was, that I had my eye on to buy at, let's say $4, $5, $6 is at 8 within 5 seconds. So what I do is I will buy the ugliness at the end of the day on Friday. I'm talking about when things are starting to get really oversold. I will wait on Monday to see the flush down continue, or because that'll allow me to get some cheaper price, and then I'll sell that maybe in an hour. Maybe it all depends on how fast things reset, or maybe the next day. So what you're saying makes a lot of sense from wherever you read it or whoever you spoke to, because 8 tick flushes mean there's some severe selling that happened. And that's a sign of capitulation. And capitulation doesn't end in one day. It normally continues for about, nowadays it happens much faster. It's compressed. In the old days, selling could last for 6, 7 days in a row. Nowadays, it maximum lasts for a day or two, because things get oversold so hard, so fast. And if the market trend is still higher, obviously they soak it up and run with it higher. We just seen this happen just last week alone. This is let me just cover this for a second. This is this is good old IWM. All right, looking pretty damn good to me on the hourly, right there. Now IWM obviously fell pretty hard because of oil, which I'd shown the day before. It hit the upper end of the channel. Like I said, and Jules, did say they were November and December. They were buying the sweeps on oil. Who the heck knows what's going to happen in November, December with oil? What the hell these guys, I don't know. Like, what do I know? What's going to happen in November with oil? So the point is, even then, they paid a much higher price. They could have waited the next day. Charts speak volumes. And I'm not saying my oil chart is very correct all the time. I'm not an oil trader, but Corey knows and many other people know. I used to use oil as a proxy big time. I don't use it as much as a proxy now because it's not as correlated with some of the stocks that we're trading at. But it was pretty obvious that it hit the upper end of the channel that it was going to pull back. So if they were still going to be buyers for November and December, why didn't they wait till the next day? Maybe because they don't have clueless A trading charts. I don't know. So all kidding aside, the impact on oil was felt in the Russell 2000, which has a large number of commodity companies in there, especially medium and small size company. But overall, it's looking pretty damn good. And as I always like to remind people, a good number of biotech stocks are within the Russell 2000. So this is looking pretty nice. Oversold here. It's on real-time mode, and I still think that on a move, which I said 125, it did go to 125 before it started to pull back. But looking at the way I chart, I wouldn't be surprised one bit that it gets to 127 or so. This is a very powerful trade, and it will happen, in my opinion, on the back of the biotech index. Okay, so let's take a quick look at the biotech index, which is, in my opinion, on a weekly breakout. All right, and I said this a while ago. Corey remembers that, So on the thing, and so what is a weekly breakout? By the way, that candle that you saw on the weekly, well, it took 2 weeks for us to see that because it was a weekly one, is a massive spinning top, a bullish, a bearish, engulfing, whatever you name it. Just throw any name at it. You see something like that with individual stocks, you get the heck out of Dodge. All right. And it just doesn't. So here is your biotech index. We like playing the biotechs. Some of you are a lot smarter on those companies than I am. I just trade them more on a technical basis. This is very nice. Okay, can everyone hear me?
Yes.
So 11 second here. Chart of Clovis. People asking, is this I'm just saying, okay. All right, so this is nice, guys. And I noticed a quick piece that I posted out there from Greg Harmon, who's is a great guy, from what's it called, Dragonfly Capital. He's the big shot on StockTwits too, right? So he mentioned the same thing, which is good. But I sing my own tunes, so let me just do this in front of you guys. There we go. Let's make this blue. There you go. This is red. See, here are biotech babies. That would be a traditional chart. Here is the second one that I give more prominence to. That breakout happened all the way back on July 18th, believe it or not, and we posted charts on that. All right, but in between, a lot of biotechs did some funky stuff. They fell hard, they went up, but if you look at the overall picture, the first major multi-year downtrend line, ladies and gentlemen, since 2015 highs was broken on July 18th, not this month. So all it basically did was this on the biotech side, which I find to be extremely bullish. All right, and one second.
Hey,
Corey, hold on your thought. Okay, 1 second. Let me just do this thing here, and I'll just show. So this, and that doesn't mean every biotech stock going to go up. I'm talking the overall sentiment in there. So I believe that this gap here, there's a gap here, is going to get filled. That's around 330 to 340. This pattern here is a very powerful triple bottom. Also, like I showed on the other one, similar to the S&P, is a cup, a small handle, and now a breakout. There are many resistances along the way, but this pattern, in my opinion, has a very high probability of getting completed. And we are roughly at 297 on the IBB. Along the way, there will be many patterns, consolidation, this and that. I'm just showing you the broader picture. Corey, your question.
So sorry about that. The only thing, does the Stowe sort of show you that they're overbought?
Yes, but not yet. Let me explain to you why. And on the weekly, look at this, multiple buying, both weeks in a row. I also look at volume. It's not that I don't watch volume. This is going to do this. By the time it gets to 340, it's going to do this. And along the way, of course, when you look at smaller time frames like 1 hour and 1 day, it's going to be a little zigzag. This now is a multi-year breakout. Multi-year breakouts carry a lot of weight. Okay? And at that point, you are going to see this thing stay above the 70 mark as the overbought condition continues, and this zigzags its way all the way up here and completes, in my opinion, that 350, 340 range. That, ladies and gentlemen, is known as a pattern completion. What happens after that? All drugs disappear? No. What happens after that is we get a big fat sell-off. So once it reaches here, it's going to create the left. This is the left handle. It'll create the right handle. Once it creates the right handle and comes down to back to that 290 level again, or the pivot. Remember, the yellow line is the pivot, right? So the pivot is here, 287. So, and that pivot needs to be held. So in answer to anyone's question that's going on their head, hey, where's the support? The support's somewhere around the 285 level on the IBB. Because once it breaks that, it breaks this downtrend line, the second downtrend line, and then it's back to the bad old days of coming down. All right. So the bottom line is, yes, it's overbought, but if the force continues, this is the fast stochastics overbought, then it will basically do this, then come down, and at that point, I wouldn't be surprised if it goes to 400 by the end of the year, because that would be the ultimate pattern. And patterns do repeat, believe me when I tell you. Takes weeks. This is the pattern completion at 400. Not going to happen right away. Those are these weekly charts are meant for bigger picture, monthly picture. So let me show you this here. This is the slow stow. All right, the slow stow is overbought, right? But what the slow stow was also overbought back in 2014. I'm sorry, 2014 for multiple weeks as the index climbed forward. Isn't the index at this pretty much the same level that was at on 2014? Yes or no?
Yes, yes.
Exactly. So if this is at the same level, stochastics are basically, they got oversold real fast here, on this big hit. So generally, it's a bullish pattern. It can, and just because it's overbought doesn't mean it has to crash and burn down here. Now, Tim mentioned something which seems like public knowledge, like Trump wins, the biotech index is going up. Let me tell you something. Friggin' Clinton wins, the biotech index is still going to go higher if you're selective, because the industry is way too powerful, okay, for one person to put regulation and stuff, and they're not going to mess with it. Okay, read in between the lines. Life is not about one-liners, right? Life is not about what's on the headlines. Everybody knows, okay? But even if Clinton wins, she's not going to destroy the biotech industry. And of course, you got to be specific. Simple. I'm not going out buying everything on the biotech side. I got a bunch of IBB calls from a while ago when I posted them, and a couple of weeks ago. I'm looking at the ones that I like, and always looking for new ideas that you guys are putting across, So we'll go from there. So that's it. You don't want to go out there and just hog wild say, okay, the biotech is it. But this is generally on a weekly basis is pretty damn good. Now, on a daily basis, I'm going to wrap this up here. We are looking at short-term overbought conditions here. We had short-term overbought conditions in July also. Keep this in mind. This is much more of a recent picture. So please focus on this, because we do play a bunch of biotechs. So in July, we went from here till August, and we got severely overbought. We continued higher all the way to end of August, and then we had a minor correction. This correction, when you look at it, is very minor. So what I'm getting at is, just because you get overbought and you get a reset like we had here, I'm not expecting a massive crash down to the levels what we saw back in July, where we were at 230. This is a definitive bottom. We are far from that. We will have bad days on the biotech side, red days and stuff, but in my opinion, as long as the weekly and the daily stays above, the weekly stays above the 70 RSI range, which is, the stochastic range, we're going to be fine. And of course, we got to look at individual stocks. So that's it. Anyone else have a question? Oh, could you please look at Clovis? Yes, I certainly can, Jules. Just for you, okay? Hold on. Get this out. This Windows 10 that they forcefully downloaded on this machine is a real pain in the butt. Seriously. Look, this thing's not going to go down now. So I got to adjust the chart. Hold on. What happened here? One second. Here we go. We got it. So I've got a bunch of biotechs here, looking at them. And why wouldn't it let me click here? So strange. Hold on. Maybe he's trying to send us a message. You can't look at Clovis. Hold on. Clovis. For some reason, Okay, let me just put it here, and because I have the chart constructed, but we can do a chart construction right here. So, all right, here we go. So here you got your Clovis. Everyone see that?
Yes.
Yes.
Very powerful. Period. And what I like about the Clovis chart, honestly, Jules, that you need to use is the one with is this 1 second. Tim is asking, is the slow still showing the same on toss versus quad? No, quad shows different different metrics. So you have to get quad in order to see the real juice. So that's the answer, Tim. TOS shows the fast stochastics more. Quad shows things just in a different way. How about I just put it like that? So you got to use that to really see it. All right, so this is your hourly chart. That's what's important to us. We're looking at it from a short-term perspective. Definite uptrend, definitely consolidations, but nothing to really like start freaking about, right? We had selling all day on Friday, on the 23rd. Nothing major, and oversold. Period, right? Oversold. Now let me put the slow stow in there and try to get an idea from a swing perspective. Oversold. Bingo. When these two things match, from a long perspective, we smile. A lot of the times you'll see this oversold and this up here, no good. When both of them match, now this is oversold, but it's starting to curl up, right? That's what I really look for. So the next time I'm saying, you know, I'm still waiting for that crossover. Remember, I was waiting for a slow crossover for a bunch of days, and I'm like, it's still not crossing over. And then it did. But once you see a crossover like this, you all got to try out this platform, okay? And just let me know, and I'll send the link out to all of you. Just call those guys up, try it out for, you know, they give you, I think, a 2-week free trial. You'll see how powerful it is. Once you see the cross, that's when you want to, that's sort of the real signal to buy. All right, just the way you saw here. So in the meantime, it might drop another $1. Lower end of the Bollinger is 36.35. It can drop, believe it or not, to 35, just the way I showed many times. Right? And those were my big buying points. So the slow stows are oversold, but they haven't curled up yet. They're almost there. I'd like to see them go like this, and that's your point of maximum entry. Okay? It's possible that's maybe $1 lower, and it's possible that it is a retest of the uptrend line, which is slightly above 35. Any break below 35, I might short the stock all the way down to 31. There. Okay. This is a major support level, 30. We know that. This is a major support level, which is around 33. Let's call it 34. So anything below 34, something's going wrong. And then these internals will reflect that. Now let's take a look at the daily. Now daily is a little bit troubling. It's troubling in the sense that you got that big reversal hammer off the 40 level. It's not that troubling because we have seen previous reversal hammers of that, you know, of the same size, and they've all reversed, right? Reversed higher. What's important is this yellow line here, which is 37.60. In order for the daily momentum to continue, we need to basically go back above 37.54. You see that on the right side? Yes? There, 37.54, purely from a technical perspective. Aside from that, everything is okay. Overbought, continuation. I like the chart which shows the Fibonacci retracements of Clovis, the ones that I posted from Thinkorswim. Scroll down, look at those, because they show you what the next Fibonacci retracement level is, which I believe shows us 48, right? So look them up today. You know, just scroll down, look them up. Go to the media section. All the charts are there. Click it. Now this is the week. That's the daily. Looking at the weekly, you can see we have a massive gap. right? Let's do something else. This is good. It's still kind of it's a gaping mouth. It's still moving higher. I don't see any cross downs. You see what I'm talking about? You always have to look at the shape of these internals too. They're still moving higher. There's a lot of force moving up. All buying. Weekly buying positive. When you see weekly candles turn negative, that's when you know things are starting to go the other way. This is what I'm going to do. Take the guesswork away. Fib. Bingo. So what did this thing exactly do? What it did was it went slightly above the white lines. Focus on that. It hit the 23.69, right? It hit the 23.69 exactly, just the way I'd shown. See that? Right there. It's resting here. Nothing's changed. The next move is 38.2. 38.2% Fibonacci retracement is $52. But this might happen. This is a handle. This is a nice cup. Is it possible that it creates a handle before it moves up to the 38 level? Absolutely. Any consolidation movement down on Clovis that I'll be watching carefully is a major buying opportunity. But to chase it totally here without any regards for technicals might be somewhat silly. If you're sitting on it, it doesn't matter. But to really like go nuts and say, oh, I'm going to buy it just because it's up $1 or $2, doesn't make sense, because we got to watch these internals, because if they start to turn down, the stock will fall $3, $4, $5. No problem. Fair enough? Yes?
Yes.
Show you one last one. I like this one a lot. It's been around for a while. We posted it way back. Didn't push it lately. I'm going to push it now. That's a fantastic chart to me. ENDP. All right? This one has a move up towards the 30 to 35 range. My opinion, high probability move. Let's take that money before they all get in there. You know what I'm saying? This was a major supply zone, got hit hard, moving up. 30 is 23.6. Stocks which have massive declines, markets which have massive declines, remember that, always have a dead cat bounce or maybe a real bounce. We don't know what the bounce is going to be, where it's going to be. That's why we use tools like trend lines and downtrend lines, which it broke out of beautifully, right, at that 20 level. And we use Fibonacci retracements. I don't know what Fibonacci was doing back in the 1600s or whenever he was around, but this is serious stuff. So the 23.6% is around 30 bucks. So you got a good solid 6 points on this stock coming up, in my opinion. The patterns also justify that, because at this point, between 30 and 35, there's going to be a lot of selling. Otherwise, if the stock gets whatever is going on with it, aside from a management change with the market liked a lot, old guys gone, the new guys in, it can, on a big ferocious move higher, can move up a little past the 50%, which is very bullish, 50% Fibonacci retracement, and hit $57. Stock has to be bought, in my opinion, for tactical traders. Got it? Good? All right. I'm going to wrap up. My wife's going to start beating me up, like, what's going on here? It's 1:20. I will see you guys tomorrow. Stay firm. It's going to be choppy. We got a bunch of Fed speakers, and I'll put a pre-market AM report out there so that everyone's, kind of matches with what they heard today with what's going on. And go have a great day, all right? And take care.
Thank you.
You're welcome. Take care, Jules, Lizzie, Corey.
Thank you, Frank. Thank you, Frank.
You too, boss. Bye-bye.